Welcome to the How Did They Do It Real Estate Podcast. Have you ever wondered how people succeed in real estate and what steps they took to get there? If so, this podcast is for you. Your hosts, Sayla and Eileen Prack, interview top experts in the real estate community to share with you their real estate journey and how they achieved massive success. Our goal is to provide you with valuable real estate resources and to help you apply it to your own real estate goal.
Thank you everyone for joining today's episode of How Did They Do It Real Estate Podcast. I am your host, Sayla Prack. Today, I am honored to be joined by Aaron Chapman. Aaron is a veteran in the finance industry with 25 years of experience helping clients better understanding, source, and financing cash flow positive investment properties. He advises over 100 clients a month in the acquisition and financing of their investment properties and primary residence. Aaron is ranked in the top 1% of mortgage loan processor in the country. In the industry of over 300,000 licensed loan originators, closing in excess of 100 transactions per month. So we're really great honors to have Aaron coming on to the show today to talk about the finance situation right now in the real estate market. So Aaron, thank you so much for spending time with me today. So how are you doing?
Doing very well, and I appreciate you allowing me the time to come and chat with your audience.
Thank you. And so can you tell us a little bit more about your background and how did you get started with real estate and how did you get started with the finance industry anyway?
Well, it's very an interesting time to ask the question like that. Coming up on 26 years ago, I was working in the mines in northern New Mexico. I had a background of cattle ranching and then working in the oil fields of Wyoming, heavy equipment, driving truck, and then mining. And they shut down the mine. In fact, you got right back here is the belt and the helmet and stuff like that from the mines. And a picture of my dad back behind me who was working the mine together back then. And when they shut down that project, I had to come back to Arizona. I thought it'd be very, very easy for me to get a job. I had a wife and infant son here and thought, I've got a very long resume. It should not be hard to get employment. It was really hard. And they kept telling me because I was overqualified for every position that I had attempted to get. And I even got to a point where we were so desperate for income that I went and applied for a $10 an hour truck driving job just to haul landscape rock. And again, I got hit with an overqualified retort and being pushed away. And I remember walking away from that place and I was literally trying to wipe tears away from my face. I was 23 years old, really in need of a job. And I was driving to a grocery store from there to get diapers for my son. I had a coupon for free diapers because we were actually too broke to even afford diapers at the moment. And as I'm driving to the store, the gas light comes on my truck. And I'd not driven that truck very far to see how long I can go on a gas light. So I went to the first store that I could see that had a gas station outside, pulled up to a pump. I had a debit card only. I ran my debit card, said a quick prayer, and I got a decline. So I rifled through my truck looking for some change or a lost dollar or something, found a few coins, locked the door, closed it, and started walking the parking lot of that grocery store. And what seemed like a couple of hours passed, I collected enough change to get a couple gallons of gas. So I got my gas. I went inside the store, found those diapers, stood in line with my one item, paid for it with a coupon, and then I tried to just get out of there as fast as I can. As I'm exiting, I was recognized by somebody. They called me out, approached me, and I shared with them a little bit about what I just shared with you. Not a lot, because I didn't go into great detail. And he said, hey, let's go to dinner. I'm like, I can't afford dinner. And he's like, let me take you out to dinner. I've got a gift certificate from a client to Red Lobster. And he took me and my wife to dinner and he shared with me about the mortgage industry. We worked together at the equipment company. He ran the office. I ran equipment. He shared with me about the industry. And that's where I got started as a telemarketer in 1997. So I hadn't talked to that guy in 24 years. I called out to him last week just because I was at an event and somebody said, hey, send a text to somebody who made a difference in your life. I'm like, I'm going to see if I can find him. I took him to dinner this last Tuesday and I got to reconcile what had happened there and share with him the story because he never knew it. He never knew the difference he made in my life. And as you said right there in that quick little write-up, I put 300,000 licensed loan originators. It turns out there's over 1 million people that do the job that I do. And this last year, I was ranked number 7 in the United States, number 1 in my state, number 7 in the entire industry, and then number 1 in the real estate investment space. Because it's the number 1 in my industry. That's people do refinances on houses, first-time homebuyer stuff, all of that. So number 1 in the real estate investment space. And, I had him to thank for introducing me to it, even though I didn't seem like the guy that would remotely even go anywhere in an industry like this, much less outside of roughnecking of some sort, to becoming number 7 in the United States and number 1 in my space.
That's amazing story, Aaron. Thank you so much for sharing that. Then, like inspiring story. So, like, like to jump onto the number 1 in the real estate investment, like in the country. Like, what are some of the things, or like challenges along the way, or the biggest hustle that you have to do in order to get to where you're at today?
It's trying to be ahead of the industry in the sense of thinking ahead in a way that the industry doesn't think. One of the biggest difficulties I had was 2008. We went through the crash of 2008. Luckily, it's going to sound weird. It was lucky, but I got into a motorcycle accident on August 8th. I woke up in the hospital. Basically, I was wheelchair bound at that point. And as a result of the injuries that I'd sustained, I also had a head injury that my memory was affected heavily, and it would actually restart every 3 to 5 minutes.
Oh, wow.
And so I came out of that. I went into the hospital worth about $3.5 million with different investments I had. At about 190 pounds, I was basically looked like what I look like now. And I was, did marathons and triathlons and things like that. I got wheeled out at 156 pounds with a negative net worth of 1.5 million. And so where it got lucky is there's so many people in the industry that had to leave the industry entirely, that completely lost everything. And they had no story to tell the creditors. When creditors came calling, there's like, I'm in the mortgage industry. When they come calling to me, I'd send them the first medical bill I received, which was $1.7 million for my first week. There was a total of I think it was about $5-6 million total that was spent on putting me back together. But then I came back to a completely obliterated industry. Nobody was in it except for 2 people that was in it before, because I didn't have anything going on at that point, but just 2 realtors. One was my mom, and one was named Carolyn with Caldwell Banker. And they were gracious enough that when they'd call me and give me a referral, they'd call me back and say, hey, did you write that down? I'm like, write what down? Because of my memory. So then they would coach me, and I'd get my notepad, I'd write things down, and I would have to call people off of that. And then I would scratch it off as I do it. Sometimes I forget to scratch it off, and I'd look at my notepad, I'm like, oh, I got to call this person. I would call them, give them my spiel, and they're like, yeah, we talked 10 minutes ago. And then have to explain to them that they're working with a guy that has a memory that resets. So it's a very interesting time to learn how to redo business. And then I was working at Bank of America at the time. I finally left there. I got a job somewhere else. And I had the opportunity to start working with the real estate investors that came into Arizona, because one of the big, what they call a turnkey provider, if you will, in the state of Arizona, I happened to start doing business with, because I was able to do 2 loans that no other lender could. So like, you're going to do all our deals. Then investors came in to work with them. And then I started working with those investors in Arizona. Then they went to Indiana. Then they went to Texas, then Missouri. And I just kept expanding my business, trying to do what nobody else would do, which is working nationally. And I built it up to 30 states. I have a staff of 22. And that's another thing the industry doesn't have. The industry, when you're talking about a loan originator like myself, you have to work with a company that has a processing department and a underwriting department and a closing department and a funding department and an auditing department. I was able to arrange it over these last few years to have every single person on my staff, on my team. So you're not working with the department, you're just working with a different team member that goes at a different stage, like going to Chipotle to get a burrito. So every time you have a different burrito, a different person in the burrito, there are different specialists at that different point.
Yep, they just want to make sure that you have all the specialists, for every department, or not departments, like every points for your business. And Aaron, so listening to your story, like you coming into today, I'm pretty sure there's a lot of mindset involved in it, right? Like you got into the motorcycles accidents, and you coming from a negative, net worth, and to where you're at today. So a lot of people, possibly, like I would say, majority of people would just give up, right? But you did not. And what keeping you, keep going and striving and motivated you, to build a successful company today?
The biggest motivation is I didn't want to go backwards. So when I was introduced to an industry like this, and I went from telemarketer to being able to do some of those loans and just little incremental growth, right? It was not fast. It's very, very slow. 1997, I didn't start hitting, making 6 figures till I hit like 2002, 2003. And then from there, it was slow incremental growth. And when the crash happened, like, I did it before, I'll do it again. and I know more now. And so I just keep going. It's like, what else am I going to do? I'm not going to go back to on heavy equipment. I don't want to do that. I want to rebuild this, but it's like, how do I do it differently? And so it was by having different ideas and thinking beyond what the industry was telling me. I think one of the bigger benefits also is me coming from an industry that's completely unrelated to this. When you come from an area that is the banking arena, or you learned how to do this the way that they tell you how to do it from some people coming within the industry and learning it as like like somebody on the operations side coming into the sales side, you just do it the way you've been taught. I didn't know what to think. I'm like, some of this stuff seemed cumbersome and stupid. So I wanted to redo it, but nobody would let me. And I'd fight with them. So I found some people that would let me do it. I've had to restart a few times and change things and fight with people. And you start finding that some people want to steal from you. And I've had lots stolen, but you just learn from it. The more you lament on yesterday's issues, the less you're able to get things done today. I also found that it's impossible to become successful until you've had a pretty significant ass beaten. So I don't welcome them. I don't love them. But when I'm in them, I try to understand, what do I get to learn from it? And sometimes it's ugly to have to walk into that beating. And sometimes while you're taking the beating, you got to be willing to step forward and take an even more beating. Sometimes it might be better to walk away. But I'm of this mindset is like, the easiest and fastest way through any problem is straight through it, not around it, and not run away from it. You got to go right into it as hard and fast as you can. And the only way I learned that was all the beatings I had taken. The motorcycle accident taught me more than anything, because I had to learn how to walk again. I had to train my brain again. I had to suffer through a shit ton of pain. And not only did I come back from that, but I took everything I used to do before the accident. I was a mountain climber. I was a hiker. I was a mountain biker. I would do marathons, things like that. And I used that skill set when I got it back to go out and do rescue for the sheriff's office. So I became the head of the technical rescue unit, the guys who do the rappelling and and go into confined space or rappel out of helicopters. I did that. I did that for 9 years, actually. I got international media attention for some of the rescues I conducted. I led a lot of them. I personally handled some of those things. It was just an amazing experience. I retired from that in 2018 and took that experience to continue to keep building my business. Now, I did that while I was building this business. And right now I've got a team that we're fighting through a really, really tough market. It's not easy, but what I do know also is everybody else is fighting the same tough market. I'm not by myself. In the sense that there's everybody else in the industry is doing the same thing or fighting the same thing. I just have a better team to do it with, and I will survive better than anybody else. The only thing I won't is when I give up.
Right. So, and Aaron, based on your experience in the last 25 years, you went through multiple recessions. What do you think about the market right now, the real estate market and the financing market right now? At the record of this podcast, it's June of 2023. What is happening in the market that you see right now?
What I see is a lot of people that are going very, very slowly, and they're walking with a lot of fear unnecessarily. And the reason it's unnecessary, in my opinion, because I deal a lot with your turnkey investors, people buying houses that are single family, duplex, triplex, fourplex. And what you have is a history of quantitative easing done by the federal government to bring interest rates very low. And because of that, those low interest rates since 2009, everybody's of the belief that that's a normal market. It's not a normal market. That's an anomaly. In fact, I'm going to share a screen with you right now to kind of see what's going on, or what was a normal market. So what I'm pulling up here is a graph, or at least it's a spreadsheet that comes directly from Freddie Mac. And in there, I have 2,720, I think it's 207, 24 lines of information here that shows you the interest rate for every month since 1971. Mm-hmm. And this is for people buying houses to live in. So the average interest rate for people buying houses to live in since 1971, according to Freddie Mac, averages at 7.74%. Now, again, we talked about the quantitative easing, the Federal Reserve dumping in trillions of dollars, $8.9 trillion into the market to bring rates down and stimulate the economy from 2009 to 2021. You take out that time, section that out, and you just look back, say, 1971 to 2009, prior to that, the average interest rate was 9.12%.
Oh, wow.
That's the average rate we had before the Fed's involvement. Now, if you go from the 2009 to 2022, when it was heavy Fed involvement, the average interest rate during that time period is 4.03. Now, after the pandemic of 2022, excuse me, 2020 from the pandemic to the end of 2022 is 3.34. So what you do is you peel all that out, you start to see the average rate really was 9.12%. And even factoring in the Fed's involvement, we got an average rate of 7.74. So anything you have below 7.74% for an owner-occupied interest rate is a blessing. Anything below 9% is a blessing. That's lower than the average. So when people say, well, we're going to get back to a normal market's probably 7 or 8%. When I got in the industry, it was over 7% in 1997. Mm-hmm. I spent a year working 2 jobs until the market dropped enough to get to 6.875% for your average homeowner. And my phone blew up and I was doing a ton of deals. Then I could replace my income from the other job and I could go full time into this. But that was when the rates got below 7%. So when people tell me that, well, the rates just jumped up and it's really, really high, and when's it going to come back down? Guys, it's not coming back down. Let me share this one with you as to why I believe it's not coming back down. So this right here is what they call the mortgage-backed securities. When you're talking about real estate loans, have you ever seen the movie The Big Short, by the way? Okay. In The Big Short, they talked about Lou Ranieri with Solomon Brothers that got the thing and say, the banking industry takes in all these deposits from their local people, and then they will pay them a certain amount of money in their checking savings account as basically the right to use their money, but they'll lend it out for like 3 times higher and they'll keep the spread. Why can't we do that? So they did it on a larger basis, and they reached out to pension funds and to people that ran mutual funds. All these things say, hey, invest over here. We'll pay you a flat rate of return, but then we'll lend out and we'll keep the difference. Now, in this situation, I'm showing you what's called the universal mortgage-backed security, which is the 5.5% coupon, meaning whoever invests their money into this, it's like the T-bills. You're going to get 5.5% on your money religiously for the time you have your money in there. And what they're going to do is they're going to lend it out, and at a higher rate, they're going to keep the spread. Now, what I'm showing you here has multiple different lines in here. These are called your moving averages. They go anything from a 14-day moving average, which is your purple line here. You've got a 21-day moving average, which is your orange line here. You've got a 35-day moving average, which is your green line, a 50-day moving average, which is light blue. The red is your 100, and your 200 is this dark blue. Now, I'm going to point at the 200. Now, there's the 200 I want you to look at, and then there's this yellow line. This yellow line, I'm going to actually zoom out back to 2008. This takes you all the way back to 2008. This is way back in August 2008, right around the time of my accident. Actually, this is June 2008 here. Here's August. Right here is November 2008. November 25th, to be precise, is when Ben Bernanke from the Fed came out and said, we are going to start quantitative easing. And then when he described it, saying, we're going to print money, we're going to throw it into the economy, and we're going to buy mortgage-backed securities so people can lend more money. Look at what happened. This is right here. It jumped up. Everybody came in and started investing in those pools along with the government because it made it worth more. The yield went higher. And we have stayed lower, or there's been more money in there ever since. Therefore, interest rates went lower. This represents the lowest interest rates ever in this period. Now, right here, it was October 13th. And it's not going to be a corresponding date on here because this is 1 month increments on this instead of daily increments. When I zoom in, October 13th, they announced quantitative tightening. Now, look what happened. They announced it. The bottom just fell out of it. Interest rates more than doubled in no time. So from October of 2021 to October 2022, we literally almost tripled in interest rates. Now, what I find is very interesting when we zoom in here to the last year, you can see this. I'm going to span this out just a little bit more. See this 200-day moving average that I talked about earlier, that dark blue line?
Yeah.
So as you see here, it's following that moving average. But every time the market tried to get above that with traders buying into the pools, they sold off and went below it. Try to get above it, sold off. Try to get above it, sold off. That is what I believe is our new ceiling, and where we're going to end up being it's not going to go below that, or we're not going to trade above it. Therefore, interest rates not going to go below the point that they were when it traded to that price point. Now, if you look here, this is May 25th of this year. The 200-day moving average intersected with that same price point set in 2008. It's my belief that this 200-day moving average will continue to be a ceiling, and we're not going to get above this as a secondary ceiling. So we will continue to trade in this lower level here. Therefore, interest rates higher than where we're at now. Now, do you know the name Charlie Munger?
No, I don't.
Do you know the name Warren Buffett?
Yes.
Okay, Charlie Munger is Warren Buffett's business partner, who's 10 years, I think he's 10 years older than Warren. He's like 91, 92 years old. So if you watch the Berkshire Hathaway shareholders annual meeting, he sits right next to Warren, both sipping a Coke and talking about what's going on with Berkshire Hathaway. He's a guy that looks like Kermit the Frog. So he said in a CNBC interview, I believe with Aaron Burnett, in the last 6-8 months, that we have seen 40 years of declining interest rates. It is his belief that we're going to see 40 years of increasing interest rates. I have the link to that particular edited version of that interview, because they only put out it was probably I don't know how long it was, hour long interview. Somebody had edited it to, I think it was like 17 minutes, and that statement was in there. You click on that link now, you can't get it. It's taken down. It's made private. So I have spent hours, probably 6 hours, listening to every version of that interview, and it's been taken out. I've downloaded the transcripts, and I can't find that statement in there. I believe it's been redacted. So the world they don't want people to know that interest rates are going to be going up going forward, because they're not going to do this again. They can't control it. They've completely hidden what interest rates used to look like, so nobody remembers. In fact, I was just at an event where they had kids that were, in there below 20. Most of the kids there were below 20. Well, 70+% of their life has been with interest rates below 5%. When I was 20 years old and younger, 70% of my life was double-digit interest rates. So what we have is this gap between those those generations, that there's a limbo there. And so trying to get people to understand that interest rates really don't matter, especially on a 30-year fix. And the reason it does not matter is because we're in an inflationary environment, correct?
Right.
Do you know what the current rate of inflation is?
As of June of 2023, I do not.
So I'm going to go to some place called shadowstats.com. Have you ever heard of that?
Yes.
Okay. So if you go in there, I'm going to go ahead and just share this screen for the people who are watching. Go to shadowstats.com, and then you're going to go to their alternate data tab and scroll down to inflation. And what they have done here with this, I like the second graph. I like to zoom in on that, because it shows you how inflation was tracked from the very beginning in the 1980s, and that there was a point where they started manipulating how they calculated inflation. They're basing it more off of durable goods that you don't have to spend money on very often. They're also basing it off of things that they can affect with monetary policy. So you start to see this gap widening between the two, between the Fed's measure of inflation and the real rate of inflation. Fed's measure of inflation says it's below 4%. The real rate of inflation is probably somewhere between 12 and 13%, because we're literally, if you calculate all the things you spend money on a day-to-day basis, your cost of living is much higher than what they express. Now, if you look back here in 1980s, we have seen we have been above 8% inflation for the majority of the time that we've been calculating inflation, correct?
Mm-hmm. Right.
So the reason I bring that up, our interest rates are below 8%. So if you borrow something for 30 years and it's at 7%, and our inflation is well above 8%, means the dollar's losing at least 0.666% of its value every single month. So every time you make a payment to the lender, you're actually giving them less money. Because of that inflationary environment, we get to raise rents. We get to increase our rents all the time. So let's say you bought a $200,000 house. Mm-hmm. It's got an $1,800 a month rent on it. You're only making $100 a month cash flow, and that's a suck deal. Most people won't take that deal. I'm telling you, you take the deal if you can keep it reasonably rented for the entire time you own it, and you can raise rents. And here is why. Now, if you bought that house for $200,000, you put 20% down. How much did you put down?
Possibly like 25% or 30%?
20%. Let's just say 20% of 200,000. What is 20% of 200,000?
40,000.
$40,000. So that means you got a loan amount of how much?
Of 160.
160,000. And let's say you had costs of about 10,000. So you invested $50,000 in a deal, right? That's your investment, your money, 50,000. The bank put up 160,000. Now, if you bought a property, you can keep reasonably rented the entire time you own it and you can raise rents. Who pays off the 160,000?
The tenants.
The tenants do. The group of tenants over 30 years. Now, if you take that 160,000, everybody do the math. Get your calculators out. Pause this. Get your calculator on your phone. Take 160,000. Hit your divide button, and then put in 30 because that's how many years it's going to take. So 160,000 divided by 30, and hit enter. You will find that that's $5,333.34. That's how much your tenants are giving you every year, averaged over 30 years by paying off your 160. Now, you have that number, $5,333.34. Hit your divide button again and type in how much you invested, which is $50,000. Hit it again. You'll find that that is equal to 10.6% of your 50,000. That means your 50,000 grows by 10.6% every year that you have somebody in there occupying the house. Even if you don't make any cash flow, just them paying off the loan, that's a 10.6% increase. Now, because we live in an inflationary environment, our property values are increasing, correct?
Correct.
Now, right now, you're going to hear some people say, no, I heard the median home price is going down. The median is going down. That means when you look at all housing across the board, the median's dropping because people aren't buying as many luxury homes right now. Luxury homes are actually shrinking. Because of that shrinking, the median's going down. But the affordable housing keeps going up. They're seeing it going up between 5 and 7% year over year right now. So we're only saying 2.5%. Let's say it goes up by 2.5%. What's 2.5% of $200,000? $5,000, right? So it went from being valued at 200,000 on the first year that you bought it to the next year, 205,000. You take that, divide that 5,000 into your investment of 50,000, you'll find it's another 10%. Literally just by having somebody in your house and buying in a very, very, very nominal market of 2.5% appreciation, you're making 20.6%. Where else are you making that kind of a predictable return?
Even without like the cash flow you were talking about, without the cash flow, there's no cash flow whatsoever. Just calculating the inflation, the debts, the tenants coming in and paying for your rent or for your mortgage, basically. And
yes, you're making 20%, 20.6% just in that. Now let's get into that cash flow. I said the cash flow is only $100, right?
Right.
That's suck cash flow. Nobody likes that, right? So with that cash flow, you still get to raise rents. How much are rents going up by year over year right now in the United States?
I personally don't know. It depends on the market.
Up. There's areas they're seeing double digits.
Correct.
Still, so I'm just going to say 3%.
Okay.
3% is very, very weak, very, very nominal. So if you rented it for $1,800 a month and made $100 a month cash flow, now you're taking that $1,800 and raising it by 3%. What's 3% of $1,800? Everybody
$54.
$54. That's not sexy at all. Nobody gets excited about $54. You as the investor is not getting excited about $54, and what's more importantly is neither your tenant. Your tenant's not running away for $54. But Think about this. Your cash flow just increased by 54%.
True.
From 100 to 154. Then the next year you raise it again, it's going to be like $56. And then you do it again and again. Now you can see within 5 years, where are you at? You're about $300 a month, $350, something like that. Now it's substantial and it's starting to gain steam. But where it gets really, really sexy is, does the lender get to raise the payment because of inflation? They do not. They have to accept the exact same dollar amount every year. So what that payment is, the principal and interest payment is $1,118.74 for 30 years. And then when you add that all up over 360 months, you're going to pay $402,747.56. Most people say, I want to pay that off because that's a lot of money, so I'm going to pay it faster. I'm here to tell you, no, do not pay that off any faster than they're willing to accept it. And here is why. Every time you make the payment, the dollar is worth less. take that difference and reinvest it somewhere else. Because when you recalculate the value of every dollar as it leaves to pay the mortgage, yes, you paid $402,000 of those dollars, but the value of those dollars over 30 years erodes to $152,466.23. You paid less than what you borrowed, and you paid it with somebody else's money that you got to raise on a year-over-year basis. So and you don't have to figure this out on your own. I've got an app. You can literally go right to the App Store right now and download the QJO investment tool, as in the quit jerking off investment tool. I named it that because that's all you're doing when you're wasting time on interest rates. You're never going to pay it back anyway. And what's really interesting is people right now are so crazy about rates. They're shopping for rates. And as they're shopping, they're going up. So when they find the lender with the lowest rate, it's actually a higher rate than what they would have if they just locked with me 2 weeks ago. Right? They're wasting time and they're jerking off on stuff that they shouldn't be. Now, I'm going to send you, when we're done, I'm going to send you an email that gives you the videos on how to use my calculator. It's got 5 different calculators that we as lenders use, that you as an investor could use to help you in your business. And you get the time value of money, and it's all free. I spent a pile to be able to create this app for you. It's yours for free.
Awesome. Thank you so much, Aaron, for going down in so much detail of, like you said, like we just buying the properties, right? Forget about cash flow, but there's so many factors into it. Inflations, the increase of the property values every years. And
we didn't even touch the taxes.
Yeah, we didn't even touch, right, which is the next thing about the tax, right? Tax deduction, depreciations and everything else, which we haven't even calculated into our calculation yet. So the real estate market is still the best place to invest for the investor, basically.
It's the most predictable investment you can possibly have. And the only thing you have to do as an investor is get the right people to work with and pick the right asset that you know will keep people in it, and take care of the people. Go reach out to your damn tenants, talk to people. The more you communicate with people, the better off you are. Be firm, be hard, don't put up with any crap, but be friendly and talk to people. You'd be amazed at what you can accomplish just by building a relationship.
Right. And also, Aaron, with all these benefits of investing in real estate and all this return that's coming back. So when you're evaluating a properties like a single family rentals or 2 to 4 units, right? How do you recommend our investors or our listeners actually evaluating the property? Are you including all those inflations and debts and everything in there? Or how did you calculate it and making sure that this is a profitable property?
That would be understanding your market, understanding the people within it, and understanding whether it's not one of those type of areas that does have a lot of renters. So we're becoming a rental based economy. When you think about the aim and the push of people in authority, I don't want to call them power because it's all perceived bullcrap in my opinion. I mean, look at what Jeff Bezos just did. Just recently he had started up a company with some other affiliates that they own. I don't know how many hundreds of millions of dollars in houses. But because it's a massive rental market that we have across the globe or across the United States. You also have the World Economic Forum. That's where I keep saying you're gonna own nothing and be happy, because they're trying to turn us into a bunch of renters. Look what BMW tried to do recently. They tried to sell you a car for a base price, but it has all the features available, but you can't use it unless you subscribe to it. They're trying to turn us into a society of people that have to subscribe for everything. Rental is no different. You're subscribing for your housing. So we're trying to become a subscription-based society that you don't own anything, but you literally just pay a monthly fee to access everything. So because of that, you've got to be able to evaluate what markets will have the most drive for people to want to be there and to rent those homes. They're being conditioned. So since the average person is being conditioned, take advantage of the conditioning. Don't be conditioned yourself trying to become, elevate above that crap. But it's the nature of the way the world is working right now. So take advantage of it.
Awesome. And Aaron, so, going into the end of, the second half of 2023 and potentially coming into 2024, what advice do you have or suggestions do you have to real estate investors? Should they just keep going out there and get in, to the game and start buying, or wait? And I hear a lot of people just say, wait, the price is going to come down, So
what is your suggestion? Coming down. We really don't know if the price is coming down. I got something else to share with you guys. A lot of people are saying, well, we have fewer sales than what we had the last few years. And so, I'm thinking because of that, we're going to have the price coming down. Let me show you a chart. This comes from the St. Louis Fed. it shows you the inventory. We have less than half the inventory we had in 2019. That's why there's fewer sales. There's less on the market, people. And look at what's also happening with the National Association of Home Builders. They're focusing on apartments. People are not focusing on single family residence right now. We have fewer builds going on right now than we've ever had. We have a pile of contracts. So I think at last I saw it was something, I can't remember how many hundreds of thousands of contracts. I had the data somewhere, but only 60,000 of them were on built homes. So because of this, we don't have the inventory to satiate the need. So anybody get your hands on single family housing right now is an absolute premium because they're not trying to build more of it. In fact, some of the areas right now, they're trying to stop the building. I'm in Arizona. They're trying to stop the building in Arizona because of what's going on with water. So there's so much going on in this world that anybody who invests in real estate, if they wait, I think that they're going to be left holding the bag later and they're going to be wishing they jumped into it. It's kind of like being a star football player, wanting to be on the highlight reel, but you want to preserve your energy. So you sit on the sidelines and wait for that play. But you come to find out the only people on the highlight reel had their ass on the field. So what you need to look for is the baselines. What makes a deal for you? Too often people thought what made a deal for them was getting a 14% cash on cash return. Well, that is gone. It's been gone for a long damn time. But can you get to that level of cash on cash return is your absolute must? Yes, you can. But you're going to have to be patient. It's like building any business. I deal with a lot of doctors and dentists, and I tell them when they have this question, like, should I really do it? It's not cash flowing right now. Like, how long did it take to cash when you open your dental practice? Like, damn, that was like 6 years. I'm like, yeah, same thing. You may cash flow only $100 a month now, but you're going to be $500-$600 a month in 5-6 years, right? Yeah, that's true. Well, same thing with your dental practice. There was never in history did we have a time where any mentor of anybody said, start a business because you're going to be cash flow day one. They said, save at least 3 to 5 years worth of reserves, start your business because in 3 to 5 years, you'll be profitable, but you got to stick it out. We're in a market today that the people who win are the ones with the strongest fingertips. And if you don't have that, then get the hell out of it and get out of the way for the rest of us.
That makes sense. Thank you so much, Aaron, for the message. And is there any messages that you want to give it to our listeners or recommendations to our listeners that I haven't asked?
One, you got to go to the website, aaronchapman.com. That's how you get in touch with me. Go to the media section. You're going to see this podcast on there, as well as I've got a video I put out twice a week that shows what's going on in the market and how it affects you as real estate investors. You can go to the YouTube channel, search for Aaron Chapman, subscribe on that one. But ultimately, guys, quit working and running around looking at the amateurs that don't know what they're talking about. The majority of people in the industry right now have been in it since the crash of 2008. They have not seen a real market. They have no idea what a real market is. And the ones that tell you, hold on, the interest rates are going down, that's pure hope. And hope is not a business strategy. What you need to do is find the deal that works today, regardless of what ends up happening, because I could be the lowest interest rates we see. And the last thought I'll leave you with is don't get suckered into short-term loans. Some people say get a 5-year and then refinance later. We don't know that that's going to be a possibility. Warren Buffett himself said that the 30-year fixed mortgage is the greatest financial instrument in history because it's a one-way bet. If you're wrong, you just refinance to the lower rate if you want it. But we just proved with my app, it doesn't matter what the rate is. But if you're right, you protected yourself from rates going up and you have potential financial devastation down the road.
That's awesome. Aaron, thank you so much for spending your time with me. As for our listener listening, so I will be making sure that we put all your apps information on the show notes as well, so that everybody can download the apps and all the calculators. So Aaron, thank you so much for spending time with me today, talking about the, like how you get started with the real estate and, like with all the insights about the financing industries and recommendation to our investors, how not to stay on the sideline, like jump in and invest, like if it makes sense for you, it depends on what you're looking for, right? So at the end of the day, real estate investing, like it's still the best out there, the best asset class out there. So 100%. Aaron, thank you so
very much for letting me come on and be part of the thing. And I definitely want to come back. I've got a book coming out soon. It's all about how to take a beating.
Awesome. Aaron, thank you again.
Thank you.
And thank you for listening to our podcast today, brought to you by Bonavest Capital. We would really appreciate it if you can go to iTunes right now and leave a rating and written review. Also, please don't forget to subscribe so you can always get the latest episodes. You can also connect with us on Facebook, How Did They Do It Real Estate. We'd love to hear your feedback and any topics that you're interested in for future episodes. Lastly, to learn more about us, you can go to bondwithuscapital.com and fill out the Contact Us page so you can speak to us directly. Nothing on the show should be considered as specific personal advice. Please consult your legal, tax, and real estate professionals for individualized advice.